We will discuss the features of taxation and the regulatory environment surrounding it. So I guess the first question to ask ourselves then is, what does the government actually spend our taxes on? So there are a number of things that the government uses our tax money for, and these are not limited to, but include the following. So for use in the hospitals, for the local schools, the police force, any retirement pensions, social benefits, and finance government borrowing. So the wealth of nations then was a theory and conceptualized many, many years ago by a famous economist, Adam Smith. And this was the way in which he defined a good tax. It was fair, so it would reflect a person's ability to be able to actually pay it. It would be absolute, so it would be certain. It would be convenient, thus making it very easy to pay, and it would be efficient, so there would be low collection costs associated with it. So the major policies of a good tax policy on the back of Adam Smith's concept there are as follows. So equity. Tax should be fairly levied between one taxpayer and another. Efficiency. It should be cheap, it should be easy to collect for the government. And this is why things such as the pay-as-you-earn scheme exists. And it should have economic effects. The economic effects should reflect on each individual's ability to actually pay. So it will state the amount of tax that you should pay, and it should be relative and in line with how much you would earn. So you need to be able to distinguish between direct and indirect taxes. So direct taxes we will have a look at first. So these are paid directly to the government by the person or the entity that is liable for them. A person or entity must pay tax directly to the tax authorities, and it will be based upon income. So examples of this include income tax, capital gains tax, and corporation tax. Contrary, we have indirect tax, and this is simply when it's borne by one party and it will be collected and paid to the government by another party. So a good example of this is VAT. We go to the supermarket, we buy a can of Coke or whatever it may be, we pay the 60 pence to Tesco's. Well, that includes VAT, so Tesco's will keep that 50 pence. The 10 pence extra they will then pay on to the government because it is a tax payment. So the tax is imposed on the final consumer of the goods or services. Tax bases then. Well, what are they? So they are subject to tax. They tell us what is being taxed, and taxes may be based on the following. So it could be income, which would be income tax. It could be capital or wealth, which is capital gains tax. Or it could be consumption, which an example of that will be your excise duties or your VAT. We will have a look at excise duties in a moment. So, incidence. This is a distribution of the tax burden. So there's different types of incidence. So firstly, we have a formal incidence. So this would be on the person who has direct contact with the tax authorities, and that person will be legally obliged to pay that tax. We then have actual and effective incidence, which is on the person who ends up bearing the cost of the tax. And this person would actually bear the burden of that tax. What is a taxable person then? So, it speaks for itself really. It is an individual or an entity accountable for the tax payment. Competent jurisdiction. So this is where the taxable person normally pays tax in the country of residence. However, jurisdiction of a tax authority has legal rights to assess, collect, and enforce payment of a tax. There would be an obligation to apply the authority's tax laws within each competent jurisdiction of a particular tax authority. Hypothecation then. So by this, certain taxes are devoted entirely to certain types of expenditure. So a prime example here in the UK is if you own a vehicle, you need to pay road tax. That road tax is used simply for maintaining roads, even though it perhaps isn't quite used how we would like it to be. Tax gap. So this is essentially a gap between the tax theoretically collectible and the amount of which has actually been collected. So this may arise because of tax avoidance and tax evasion. Tax authorities will aim to minimise this gap as much as possible. Moving on then, you need to be aware of the tax rate structures. So firstly, we have a progressive tax. So with this, we basically have an increase in amount of tax for an increase in proportion of income. So as income rises, the amount of tax to be paid will increase. Ultimately, the people who are on higher incomes are going to be paying a higher percentage of tax. So the more a person earns, the higher their average rate of tax is going to be. So an example is that in the UK, income tax is a progressive tax. The more money you earn, the more tax you will pay. We then have proportional. So this is simply by taking the same proportion of income as income rises. This one speaks for itself. We then have a regressive tax. So this will take the same proportion of income as income rises, but it will take a higher percentage of tax revenue from those on low incomes, which means the most poorly paid people are going to be hit the hardest with this one. Sources of tax rules then. So legislation produced by a national government of the country is one way in which tax rules can be seen. They could also be obtained through precedents based on previous legislation and case law. Tax authorities will also issue interpretations such as tax bulletins. Whether or not companies, individuals choose to read them or use them is entirely up to them. It may be that directives are taken from international bodies such as the EU guidelines on VAT. And there will be agreements between different countries upon how to best face this one. So we're going to have a look at direct taxes in a little bit more detail now. So we're going to focus on tax on trading income, capital taxes, property taxes, wealth taxes. So let's see what's in store. So starting with tax on trading income. So this relates to income from main business activity. Tax base will be taken from the accounting profit, and an adjustment is going to be needed to the accounting profit figure in order to arrive at a taxable trading profit figure. So there is a standard pro forma for this, which I'm going to show you now. So we would take our accounting profit, deducting any exempt income from tax or which is taxed under other rules, whilst we would add back our disallowable expenses as well as any accounting depreciation. We would deduct tax depreciation in place of the accounting depreciation. That would then lead to us gaining our taxable trading profit overall. So Capital taxes. Gains are made on the disposal of investments and other non-current assets. A gain will be calculated as sale proceeds less asset cost. So the gain is calculated by doing that. And again, there's a standard pro forma for this. So let's have a little look. We would do our sale proceeds, deducting our costs to sell the asset, which will give our net proceeds, and then we would deduct our cost of original asset, costs to purchase the asset, enhancement costs, and indexation allowance, which would give a chargeable gain figure. Up next, we have property taxes. So tax may be imposed on property based on either capital or rental value. Wealth tax. This may be imposed on an individual or entity's total wealth. It can include any pension funds, any insurance policies, and any artwork. So they were the direct taxes. Now let's take a look at the indirect taxes. So we have unit taxes and ad valorem taxes. So we're going to start off by looking at the unit tax. So this is based on the number or the weight of items, and an example of this is excise duties. The other one is ad valorem taxes, and this one is based on the value of assets. And an example of that is a sales tax. So I mentioned excise duties in the previous slide. However, you need to know what they are. So essentially all it is it's a type of unit tax, and it is going to be applied on certain products such as tobacco and sugary drinks. The reason why they are going to be imposed is to pay for extra costs such as increased healthcare for smokers, for lung disease, and essentially to discourage people from using them or drinking them or eating them. So we recently saw a sugar tax introduced here in the UK, and the idea of that was to try and stop people from consuming as much sugar. Not sure that it worked though. And essentially that is to prevent obesity and prevent any dental issues that are common if you are constantly eating or drinking sugary products. So characteristics of commodities that make them most suitable for this kind of duty are going to be if there's few large producers, inelastic demand with no close substitutes, large sales volumes, and easy to find products by the specific duty that is in place. So a consumption tax then is going to be imposed on the consumption of goods and added to the purchase price. So a single stage tax, it's going to apply to one level of production only. However, you can also get it as a multi-stage tax, which means that tax will be charged each time a component or product is sold. And there are two types, including cascade and VAT. So I'm sure you're all quite familiar with VAT, but perhaps that's not so much so for cascade tax. So we're going to have a look at that one first. So cascade tax then. Tax is going to be taken at each stage of production. The business cost, as no refunds are provided by local government, the business must bear all costs incurred. VAT, this is going to be charged each time a component or product is sold, but businesses can claim back all tax that they have paid on this. There is a formula to work out VAT payable, and it is as simple as deducting your input tax from your output tax. So there's different rates for VAT supplies. So let's have a quick look at those now. So firstly, we have standard rate, which is going to be taxed at the standard rate of VAT. Currently in the UK, at the time of this recording, it is at 20%. That could be higher rated, so it could be taxed at a higher rate than standard rate. It could be zero rated, taxed at 0%. So an example of that would be any basic food, which you do not have to pay VAT on. Or it might be reduced rate. So this would be taxed at a lower rate than standard. And I think at the time of recording this in the UK, it currently sits at 5%. And there is also the exempt rate, which basically means that no subject of VAT is due. So, employee taxation. Employees are going to be taxed on their earnings under income tax. Earnings can include salaries, bonuses, commissions, and benefits in kind. So let's firstly have a look at benefits in kind then. So these are essentially non-cash benefits in lieu of further cash payments. So these can include things like living accommodation, loans, private medical insurance, life insurance, and company cars, and etc. It may even be something as simple as a cycle to work scheme. So, employees can deduct certain expenses which are wholly, exclusively, and necessary for employment. So this is not a list of everything, but it certainly gives a few examples here. So things like contributions to your pension plan, professional subscriptions, if you donate to a charity through a payroll deduction scheme, or it could even be for business travel. So employees and entities may well be liable to pay social security taxes based on salaries. This is what is known as your national insurance contributions here in the UK. So PE then, I'm sure you've all heard of this. It is the pay as you earn scheme. So this is essentially an expectation for entities to withhold tax on employees' salaries and report earnings back to the tax authorities. What are the benefits of this scheme then? Well, the tax authority only has to deal with the employer as opposed to dealing with every single employee, which could be many, many people. Tax is almost always, if not guaranteed, going to be paid. It is collected at source. It does not leave the employer and go into an employee's bank account. It goes directly into the government's account. The tax authority will also receive regular payments from employers, which can then help the government to more accurately be able to budget cash flows. It also reduces admin costs. But that is kind of a benefit for the employer as opposed to the government. So the standard pro forma on employee tax is as follows. You do your salary plus bonuses, commissions, benefits, whilst deducting any subscriptions, pension contributions, charity donations, and personal allowances, which you would then receive your taxable income figure from. Moving on then. Administration and record keeping. Remember, organisations need to keep records to satisfy tax requirements within their countries. So, corporate income tax then. All records are needed to be kept which support the financial statement figures. All additional documents are required to support statement adjustments. Sales tax. So adequate records are required to be kept for all sales and all purchases, including any order and delivery notes, any purchase and sales invoices, as well as any credit notes that you may have received, purchase and sales daybooks, as well as sales and purchase returns daybooks, import and export documents, bank statements, your cash book, and your VAT account. For overseas subsidiaries then, tax authorities are going to require documentation about the transfer price and policy between the subsidiary company and the parent. So prices charged for goods or services provided by one to the other. Employee tax. Employers are required to keep detailed records of employee tax and social security contributions. So with this, a number of year-end returns are also going to be needed to be prepared, showing the total number of deductions made from an employee's wage, employer's contributions, and analysis of any other amounts that have been deducted from such. It is important that this is kept not just for HMRC, but at any point an employee may well ask for those details to be provided, and you would have to have that information at hand to give to them. The tax return then. So tax authorities always set deadlines for tax payments and for submitting the tax returns. So entities are either required to pay the tax following an assessment from tax authorities or will pay via the self-assessment method. There is a minimum retention period for records. So in the UK, it is currently 6 years. The reason being is the tax authorities may well question or challenge records for a good few years, especially if they're just going through doing an audit. Payment of tax then. So this depends on the rules of the tax authority and the type of tax that is due. Tax is not always paid when the return is filed. It may happen at an earlier date or it may happen at a later date. However, it is important to note that if it is paid late and it is paid after the date that it is due, there will be interest charged. Tax authority powers then. So the tax authority at any point can review and query filed returns. They may request special reports if they believe inaccurate information has been submitted, and they can examine records of previous years if they feel fit. They will also enter and search the premises and enter and search the entity's premises and seize documents should they wish to do so, and they can also pass on information to foreign tax authorities. So, tax avoidance versus tax evasion. Something that you're probably quite familiar with, but let's just have a little look at it here. So, tax avoidance then is all about using the legitimate tax rules and allowances to minimise the amount of tax paid. Tax evasion is using illegal methods to avoid paying tax, including not declaring income and making false statements. There are methods to prevent both tax avoidance and tax evasion. So some examples could be to reduce the opportunity by collecting tax at source, which we've already seen with the PAYE scheme. It could be to simplify the tax structure. It could be through the minimisation of relief, allowances and exemptions. And it could be through increased detection through tax audits. Good communication between tax authorities and entities should also prevent tax avoidance and tax evasion, whilst also maintaining a good, honest, professional, customer-friendly tax system. Reducing lost revenue by reviewing the penalty structure could also be another option.